Hello, I'm Rob Clementi, the Chief Executive of 10, the Education Network. This week in Tax Bites and Law Bites, Brian Hall from Townsend Business and Corporate Lawyers joins me. Brian is presenting a webinar on the 1st of February on tax issues in testamentary trusts. And Brian, welcome. Thank you for joining us. I know the issue that really is getting you excited is this issue of borrowing. And in particular, I'd like to ask you about the effect of borrowing by testamentary trusts on the treatment of trust income. In particular, will it still be treated as accepted trust income?
Well, that's a really good question. And these new provisions, they're really the biggest change in over 30 years as far as the taxation of testamentary trust income is concerned. Previously, it was almost always worthwhile to have a testamentary trust in a will, even with a small estate, because it could always borrow to acquire more assets, which could generate income that could be treated or would be treated as accepted trust income. So, for instance, it wasn't unheard of to actually have some wills that would set up a testamentary trust with as little as $10, a bit like setting up an inter vivos family trust with a small sum of money. Because you could always borrow to increase or add to its assets later on, and the income being generated, again, being treated as accepted trust income. But now, on the face of it, under these new provisions, you can't do this anymore. The tax office have put out a number of examples on its website, which make it very clear that as far as they're concerned, any income generated by assets acquired through borrowings will not be treated as accepted trust income any longer. So now you need to make sure that the assets from the estate that will go into the testamentary trust under the will are sufficient in themselves to make it worthwhile in terms of the taxation benefits versus the cost of maintaining the structure, assuming that taxation benefits is one of the objectives of the exercise. Now, having said that, in certain circumstances, it could be possible to overcome the restrictions, such as where the borrowings occur at the investment asset level rather than the testamentary trust level. Now, take for instance, if the testamentary trust acquired units in the unit trust. Now, that was the situation in the historic first case, which originally made it clear that testamentary trusts could actually borrow to acquire assets, and those assets or the income generated by those assets still be treated as accepted trust income. In that case, the testamentary trust actually borrowed to acquire the units in the unit trust. But potentially, you could have a situation where, in a similar situation, it's the unit trust that makes the borrowings rather than the testamentary trust. So, potentially there could be ways to overcome the restrictions. Also, it may still be worthwhile to set up a testamentary trust, even if there's little or no income being generated by its assets. So, for example, if asset protection is the primary concern of the will maker, so that whether or not there are sufficient tax benefits to make the structure worthwhile is sort of neither here nor there. But the thing is, at the end of the day, and with such little official guidance yet available, how the courts will determine how the new provisions will apply is yet to be seen. So going forward, it's very much a situation of watch this space.
Brian, thank you very much. That was a really interesting analysis of this new development, and I think many of our listeners and viewers will be interested in hearing your webinar. And if you, our listeners, would like to know more, you can register for the webinar by visiting our website, tved.net.au. In the meantime, thank you very much for